select a program for a conference like this is to have a program committee that is going to do all of the hard work. The main objectives that we had this year was to have a reasonably representative balance, both in backgrounds, in genders, in geographical locations. And we also wanted to regenerate a bit the program committee so that we bring new voices to the table. So we ended up with 42 members, evenly split between men and women. This was not, I mean, the 21-20 split, 21-21 split was basically just by sheer happenstance, but we really wanted to have a better balance. In terms of geographic balance, we also wanted to make sure that people both from the EU and the US, which are historically the two main constituencies in WEIS, were well represented. We also had one person from Asia Pacific. It would be nice if we had more people from Asia Pacific, from South America, from Africa, from Australia, and that's something that we'll work on in the future. And finally, in terms of diversity of backgrounds, we are trying to be roughly half and half between computer science and economics, public policy. We are not quite there, but we are not as heavily CS dominated as we might have been in some years in the past. Where we need to work more, and I very cognizant of that, is to make sure that we have more underrepresented minorities on the program committee, because unfortunately, they were very, very underrepresented. And to do so, I think that what we want to do in the coming years, which I did not do as program chair this year, but it's a recommendation for my successors, would be to consider inviting people who may not have published yet in WEIS, but who do have an interest and relevant interests to that community. How were the papers selected? We had 43 submissions this year. Each paper was reviewed in a double-blind format. 2 papers got 4 reviews. Most papers got 3 reviews. That means that if you count very quickly, it's about 3 to 4 reviews per PC member. The review process happened right as we were in the first lockdown. So many people had very hard contingencies with, children that they needed to take care of, parents that they needed to take care of. The world was, basically falling apart in front of our eyes. And I really want to say thank you to a few PC members that were able to pick up the slack from other folks in the committee that were not able to accommodate all of the reviews. We were able to have all of the reviews done in time, and very nice, very detailed reviews. And I really want to thank everybody for participating, especially those who pitched in additional reviews, sometimes with a request from me at very late time in the review process. Following this round of reviewing, there was an extensive online discussion by the program committee. A number of papers received public comments reflecting this discussion, and we ended up with accepting 15 papers, 11 straight and 4 with a chapered. In terms of the paper revision process, you will not see the submission version. This is what was reviewed by the PC, but then when the program committee comments came back, authors were given an opportunity to revise their paper to reflect the comments raised during the reviewing process. And that's what's currently on the website and which we'll use to seed the discussions today and tomorrow. After the workshop, authors will be able to produce a new version of the paper, incorporating and reflecting the comments and the discussions that happen here during this workshop, and we will post that at their discretion on the website after the conference. Note that there are no official proceedings in WEIS. This is so that people with a more econ background or an interest in publishing in economics journals can do so. So the proceedings are online, but there's no printed bound volumes of proceedings. So with that, I'm going to yield the floor to Brian Routledge, who is going to chair the first session on vulnerabilities. Each session will have the same format, with the exception of a panel a little bit later today. Each session will contain 3 papers. For each paper, there will be a 10 to 12-minute presentation with a 3 to 5-minute Q&A, a hard stop after 15 minutes. So we'll play the traditional Oscar music well, I don't know if we've got music like at the Oscars, but after 15 minutes, we'll move on to the next talk. And at the end of each session, there will be a 15-minute plenary panel for the whole session where all three papers, all three presenters can be asked questions that are maybe more representative of the whole session. As a reminder, the agenda is here on that website, and it is current. With that, enjoy the conference, and I look forward to meeting some of you, or as many of you as possible during the breaks. And thank you all. Brian, the floor is yours.
Brian's not going to have the floor since he doesn't appear to be signed in as Brian. Who are you signed in as, Brian? Send me a message. Oh, I can't spell Brian. My fault.
Brian with a Y, that threw you off? All right. Welcome all. I am happy to be chairing our first session. Let me just get us rolling so that we stay close to Nick's agenda as possible. Our first paper is Prioritizing Vulnerability Response, a stakeholder-specific vulnerability categorization. And it's a bunch of folks from here at CMU, CMU Software Engineering, along with Dean Schlick at Rockwell. I'm not too sure who's presenting the paper, but take it away.
Ooh, thanks, Brian. Thank you, Richard. Thank you, Nicholas. Thank you, Lorenzo. Good morning, everyone from sunny Pittsburgh, Pennsylvania. I'll get right into it here. So what we wanted to do with this paper was provide essentially an evidence-based vulnerability management system. There are several vulnerability management prioritization schemes that people might use today. I would think it's fair to say the most common one is CVSS. It tends to limit itself to technical severity, especially the base score. And we've pointed out some design inconsistencies. I think that people at WEIS are pretty well aware of this. There's been a fair amount of study of CVSS in various different WEIS events. So instead of just complaining about it, we've tried to propose something different. We want to try to focus on decisions. We want the decisions to be transparent, and we want them to be specific to a certain role, recognizing that different actors in the vulnerability management space have different information available to them, and that information is of different value, and they're trying to make different decisions. And we wanted to try to propose some sort of test that would allow you to sort of have some confidence that different actors, different employees basically would make the same decision given the same structure. So we've got the example suggestions for what you should do, and also a bit of a method for how you can customize it yourself. I think that one is what a lot of people will end up taking and running with, but I think that two, the ability to sort of have a shareable way that everyone can trust that what everyone else is doing is well justified is perhaps more important in the long run. I very much appreciate the comments from the WEIS program committee and our Shepherd. And we've also got comments from sort of presenting this at some other places, and development of SSVC is actually ongoing to continue improvement. So I'm happy to take comments from anyone, obviously in the breakout sessions or during the 15 minutes we have here at the end. But if you don't have time to set that in, you can always raise an issue on GitHub and we'll address it. So just for some background, this is the intended state of practice with vulnerability management. Basically, that you do everything properly. That, you know, the National Vulnerability Database, if you're in the US, I suppose the CNNVD, if you're in China, whatever, right? Issues a CVSS base score right away. And then people are supposed to use that as the starting point, not the ending point to their management process. You also need to have good asset management and all of this stuff. It doesn't tend to actually be what happens. You know, we've seen a lot of work that says that the NVD can be delayed by at least a month. If something is going to be exploited, it's probably going to be exploited before a month is out, so that's not super helpful. A lot of people don't use the CVSS threat and environmental metrics for reasons which I think would be interesting to study, but are not super well documented. But I'm pretty confident that they don't tend to use them, although of course some people do. Yeah, so we're going to try to help out with this. So there are some aspects of CVSS that I think enable this malpractice, although CVSS, the people who are involved in making CVSS are very clear about the way that they want everyone to use it and what should happen. So I think that there's some false precision in this 100-point scale. The one size fits all approach, I think, does not help people customize it as much as they should be able to. And there's some sort of worst possible case reasoning, which I think is causes some weird things. So what we've proposed with SSVC, which I'm not going to try to give you the details of in a 10-minute talk, is to use qualitative decision points and just not allow people to have that false precision of the numbers. So you have to actually map your decision to what the outcome is and sort of be clear about that. And we try to use credible effects in a bunch of different places and in ways that you answer the four or five questions that you need to answer to get an SSVC decision for your vulnerability. So essentially, it's a logical operation rather than an arithmetic or algorithmic, or I guess algebraic operation. So CVS is algebraic. This is logical. So you have, 4 questions with their respective answers, and if all those things are that way, then you get scheduled. And there's, in the paper that we published for WEIS, there might be 225 of these logical statements. I think we've got it down to maybe 70 now. We can compress this visually into a decision tree. A decision tree is just a convenient expression of some specific logical syntax. This is the whole decision tree for the supplier of software or the supplier of the vulnerability remediation, whatever. Obviously, it's a bit of an eye chart on a PowerPoint slide, but that is the whole expansive thing. So it's a fairly easy to manage in the scheme of how hard vulnerability management can be. Version 2 has got some changes to this, but it's the same set of ideas. We've got 5 or 4 decision points for each the supplier and deployer roles. Some of them overlap. So right now we've got 7 or 8 decision points in total. So for example, if the state of exploitation is sort of something that's important to both of them, that's something that the supplier or maybe the National Vulnerability Database or something might be able to publish, as long as they say where they're getting that information so they can inform everyone. Some of these other things, like the impact to the mission of the software deployer, is only for the deployer to know, and they're going to have to evaluate that themselves. We've gone with that off of FEMA's mission assessment for sort of continuity of operations. We've used that to sort of inform that mission impact decision. For a for-profit company, I think that the mission is often the bottom line, so staying in the black, whatever, right? And that's fine. So the things that impact your profit are going to be the things that are going to prioritize up the vulnerability spectrum, and I think that makes a lot of sense. Framing this in terms of profit or something like that would not have been suitable for all of the organizations we might want to target, so we were a bit general and said mission. And yeah, please have a look. If you do vulnerability management or you're interested in some aspect of vulnerability management, we'd be very happy to have your input. If you want to test it out and be our guinea pig, let me know, and we will be happy to have you do that as well. And I think that that's right about at 10 minutes. So, quick summary for everyone. And I think that please have a look at the paper if you're interested in the details. If you're interested in the most up-to-date details, they're still being developed on GitHub, but you can access all of those markdown documents and sort of piece it together yourself from there and read them in order. And we are about to have another couple perspectives come online. So we're going to talk about, what the coordinator might do. If they're coordinating a vulnerability, we might talk about how industrial control systems or OT people are maybe different than other software deployers, but that's all sort of still coming online. So thank you very much. And I will take questions, in 20 minutes, I suppose.
Awesome. We are keeping to schedule. That's always a good thing. I didn't see any clarifying questions or anything is in the chat. So I think moving to the second paper seems like a good idea. And then we'll revisit all this when we get to the group discussion at the end.
All right, thanks, Brian.
All right, thank you. The next paper up is Denis Malouris and Andrew Simpson on underlying and consequential costs of cybersecurity breaches, changes in systematic risk. All right, we're going to do some finance.
Exactly. Hope you can all hear me all right. Brilliant. So good afternoon, everyone, and thanks for attending this session. As Brian just kindly introduced, in this presentation, I will talk about a study Andrew Simpson and I conducted on changes in systematic risk following information breaches. So just to talk briefly about the motivation and background of our study, I think we can generally all agree on the observation that data breaches can prove costly to organizations, but quantifying that actual breach impact is rather difficult. And particularly because we lack knowledge of costs that are not easily observable. And in order to invest security budgets in the most efficient way, though, so that means generating net positive investment cash flows, we need to be aware of all those costs. So we conceptualized what we call the iceberg model of information security costs. After our literature review found that most of the studies, surveys, and empirical models focus on what we call direct or obvious costs of information security. So we find that what we call the underlying and consequential cost category is rather underexplored in the literature. So just briefly, what we mean by obvious costs, those are expenses that are easily observable and can be directly related to line items on a profit and loss statement. So for instance, information security standards or paying forensic auditors. Whereas what we call underlying and consequential costs are more indirect costs that are not easily observable, that cannot be attributed to billable items. So for instance, stock market reactions following security breaches. We chose this model because we think it signifies what we claim that most studies, surveys, etc., only focus on the tip of the iceberg and miss out on the information security costs that lie below the surface. So one potential manifestation of those underlying and consequential costs we deem are costs of equity that are measured in terms of systematic risk. So the sort of logic that we claim is that a security breach leads investors to reassess the risk that is associated with firms' ability to generate stable future cash flows. So greater risk assessments lead to greater return requirements from those investors. We would be able to measure that by a beta factor, which is a metric to measure systematic risk. And so a greater return requirement from investors would then lead to greater costs of equity. So what we explored is whether severe security breaches increase firms' costs of equity by elevating systematic risk, but we do not only focus on what is called the symmetrical risk. So we don't only focus on what's called the regular beta factor, but we also focus on upside and downside beta. So we analyze whether costs of equity are different in bearish or bullish markets. The related work is relatively scarce. So there's somewhat contradictory previous literature, and also all previous studies have only been conducted on either very industry specific or otherwise very small samples. So we tried to find a bigger sample. So we based our study on the PRC database. So initially that is more than 8,000 breach events, and then used out of that database, we used 2 approximate string matching techniques and manual checks on S&P Capital IQ to find out those companies that are actually public, for which we can measure changes in cost of equity. We excluded all non-direct subsidiaries. So that means, for instance, we only included national subsidiaries that are operating under the same or very similar names to make sure that investors who would read a news item about a particular company or about a particular security breach would actually be able to attribute that breach to that very underlying company. We also eliminated confounding events and what we call non-severe breaches. So non-severe security breaches, or well, severe security breaches are defined as those that are actually the result of coordinated systematic efforts, so that were actually conducted with the intent to gain utility. So that means we excluded all cases of negligence and small scale or self-contained events. So the way in which we established beta, so regular beta as well as upside and downside beta, is that we use the capital asset pricing model, which is pretty common in those kinds of studies, which is based on the idea that beta is a measure of the exposure to non-diversifiable or systematic market risk. And we then measured beta, so as it's written here, and then we also measured upside and downside beta, which is deemed to be a more appropriate measure of risk, and which is then only based on times in which the market yielded a positive or negative return, respectively. What we then did is we established basically 6 sets of 60 daily betas per event. So that means we established beta factors before a breach event and after a breach event. And we did that for the regular symmetric beta, as well as for the upside and downside beta each, as you can see here on that little graph. What we then analyzed is both the untransformed differences between beta before an event and after an event, as well as the Windsor-Rice differences, and then tested those for statistical significance. What we can see here on that graph is the average regular beta before an event and after an event. So 0 is the breach announcement day, -60 to +60 is the trading days relative to the breach announcement. So what we can see in terms of regular beta is that after a security breach event, the mean regular beta increases significantly. We do not see that for the upside beta, so the increase or the average increase is more volatile and less clear pronounced, as we can see. For the downside beta, then on the other hand, we see more of a coherent trend over this 160 trading days that we can observe here. So that initial graphical analysis was then confirmed by statistical analysis. So we can see that from left to right on this table, we can see the type of beta examined. So there's regular beta, upside beta, or downside beta. And then we can see the sample size, mean and median statistics, and then the results from student T test statistics and the Wilcoxon-Sign-Rank tests, which also both indicate, similar to the graphical analysis we just saw, that indeed regular beta and downside beta do increase after a security breach. We see that there is a mean figure of 0.022 and 0.031 associated with the increase in regular beta and downside beta respectively. So it makes sense when thinking about what do these numbers actually mean to just go back to the beginning. So security breaches do indeed elevate financial systematic risk, as we've just seen, which leads to greater cost of equity and eventually greater weighted average cost of capital. So that means that with an increase in WACC, it becomes more difficult or more expensive for organizations to actually fund their operations. And then from an investor's perspective, when the WACC is applied as a discount factor, it means that with a greater WACC, it results in lower valuations, so lower firm values, or put differently, in reduced share prices. And on a project level, what we would see are lower net present values of particular projects. So that might mean that a firm with a greater WACC might be less inclined to invest in otherwise potentially very profitable investment projects or very meaningful projects such as security investments. So as we can see, cost of equity and then by implication WACC are at the core of every investment and financing decision. And it is hence very important to include such changes in cost of equity in information security investment models and make sure that this potentially negative impact is accounted for in the respective models. Just to compare that increase that we just saw, the 0.022 and 0.031 increase in regular and downside beta respectively. So we saw that they are both significant statistically, but they're also economically significant. It's worth keeping in mind, so the numbers might appear small, but it is worth keeping in mind that by definition, the average beta, so the market beta, is 1, and beta ranges typically between 0.45 and 1.75. So to compare that to other arguably more fundamental events, so the literature would agree that earnings announcements carry a very important meaning for investors. And we see that after earnings announcements, the average change in beta is, well, just 0.04, whereas we can see that in downside beta terms, we see an increase of beta that is almost comparable to very fundamental events such as earnings announcements. Even when we look at corporate mergers, which again, as we can probably all agree, have a very substantial impact on organizations, even in that case, a change in, or an average change in beta of -0.058 is not that much larger compared to what we can see with changes in beta after a security breach event. So just to wrap this up, we have just seen that indeed, looking at those 202 severe security breaches between 2005 and 2019, there is actually a significant increase in terms of systematic risk in terms of regular beta and downside beta, and that increase is both statistically and economically significant. So we think that it's very important to recognize this cost item amongst potentially a lot of other rather hidden cost items when making investment decisions. So this study provided one novel empirical piece of evidence on cost types. So we just revealed that there is actually a cost of equity element that should be considered in holistic analyses. But as we can see, there's still a lot more space to be filled in this iceberg model. So we think that there ought to be more cost elements to be explored in the future, and there's still room for a lot of additional research. So thank you very much for your attention, and I'm happy to answer any questions now or later, or please feel free to drop me an email. Thank you.
Thank you. That was that's awesome. You guys are on time. I haven't had to use my red light at all. It's waiting if you run over time, but I haven't had to use that yet. There was one quick clarifying question that you could do in the chat, was basically, what was the window you were measuring these changes in betas over? And the context of this was, I think, Alan. Well, the questions are coming fast. Alan Friedman's question, which was the information on cybersecurity events kind of comes out over time often. And so did you consider wider windows?
We did consider wider windows. So we did consider multiple event windows. So what we can see here again is we calculated 60 daily betas. So we started 2 days prior to a security breach event and went 60 trading days into the past, and then did the same after a security breach. So we excluded the days immediately around the security breach event because the security breach announcement introduces volatility. And so we excluded that volatility surrounding the breach event itself, and then included those 60 trading days before and after a security breach event. But we also did that with a lot of other time windows up to 110 days. And so qualitatively, the results remain unchanged. So the effect is still the same, that we see a significant increase in regular beta and downside beta after a security breach event. 60 days is what we found is commonly used in the literature because it, as you just mentioned, it takes some time actually for the effect of a security breach to substantiate in terms of financial effects.
Awesome, thank you. There's lots of questions piling up in the chat, and so we will revisit all of these as best I can at the end. But we have one more paper to go in this interesting session, also with a financials theme of cybersecurity investments and the cost of capital, which is Taha Hakavar from Temple, Mahad Raham from Purdue, and Tijan Zhang from Oklahoma State University. Tijan, is it you who's presenting? You're on mute still. There you go. Now you're good.
Yeah. All right. Yeah. All right. Thank you for tuning in. And first of all, I'd like to thank the organizers for putting together this event and providing this opportunity for us to share our research on disclosure of cybersecurity investments and cost of capital. So, so if we look at the amount of money that's been spent on cybersecurity in the past decade, we see there is a steady increase from 2010 to 2018. In fact, the amount has more than doubled from $27.4 billion to more than $66 billion. Well, around the same period of time, the rate of disclosure for those investments is surprisingly low. Even for firms with higher than average cybersecurity investments, higher than the industry averages, their average disclosure rate for those investments is only around 16%. So this disparity between the increase in cybersecurity investments and the relatively low disclosure of those investments prompts us to try to understand what are the benefits and what are the costs of disclosing cybersecurity investments. So for incentives for not disclosing certain things, so the literature would say that some firms may be concerned about proprietary costs, for example, not disclosing certain secrets that may be beneficial to its rivals, but not to itself. And for agency costs, some managers, specifically for when it comes to cybersecurity, they may have the incentives to conceal certain information about cybersecurity to advance their own careers. And finally, a disclosure may provoke certain fame-driven attacks. Some hackers may view the announcements of investments in cybersecurity as an invitation to, as a challenge to hack those firms. So what about incentives for disclosures? So for starters, cybersecurity risk has become more important when it comes to credit ratings for the firms. For example, Moody's has started to include cyber risks as one of the dimensions in evaluating the credit rating of a firm. So that means whenever a firm decided to disclose more information about their cybersecurity investments, then it would potentially get a higher rating and also a less cost when it comes to access finance. So we know from previous studies that disclosure would reduce information asymmetry and therefore reduce the cost of capital, that is cost to access debt and cost of equity. So this is important because that means investing in cybersecurity is not just about preventing the data breaches, but also has a tangible business benefit to it, namely reduction of cost when it comes to access finance. So our question that we want to study is whether disclosure of cybersecurity investments would reduce a firm's cost of capital. So we believe there are two important dimensions that may strengthen this causal link. For one thing is informativeness of the disclosure that speaks to the quality of the disclosures, and coverages by analysts that speaks to the exposure of those disclosures of cybersecurity investments. So to test this empirically, we have the data from 2000 to 2018, and we have about 6,000 public firms. And about 30% of those firms have disclosed at least once about cybersecurity investments in our sample period. So to measure the cost of capital, we use a WACC measure, that is a weighted average of cost of debt and cost of equity. And for this disclosure of cybersecurity investments, we use keywords to identify the paragraphs about cybersecurity investments, scaled by the total number of paragraphs in SEC filings. So we also have this informativeness score for those disclosures. And we follow the literature on the analyst coverage, the number of analysts covering the firms. So this is our specification. So cost of, we have our main interest is in the coefficient on DCIs, or disclosure of cybersecurity investments. And we also have this cross-sectional informativeness and coverages. So for identification, we have Horstman type instruments to start with. For example, we have the average cybersecurity data breaches in the industry. So the idea is that firms in a higher risk environment are more likely to disclose their investments in cybersecurity so as to calm potential creditors. So this is our main result. We see that there is a negative relationship between disclosing cybersecurity investments and the firm's cost of capital. Now, in terms of economic magnitude, one standard deviation increase in disclosure of cybersecurity investments would correspond to about 13% decrease in the firm's cost of capital. Now, we also have this alternative instrument that is commons letters, where SEC provides certain guidance on disclosures for firms. So our analysis provide consistent results when instrumenting using this common letters, whether it's cost of capital or cost of equity or cost of debt. Now here we have this cross-sectional analysis looking at institutional preferred stocks. So the idea is that institutional investors are more likely to have the capability or expertise to parse those information in those disclosures of cybersecurity investments. And therefore, we see that the reduction in cost of capital due to the disclosure of cybersecurity investments very much concentrated on institutional investment targets versus retail investment targets. Now here, what about those firms that talked about cybersecurity but do not necessarily invest in cybersecurity? So in other words, disclosures without significant cybersecurity investments. So we see here, for example, in column 2 and 3, that firms that invest disclose about cybersecurity investments, but its cybersecurity investments is higher than industry average, then not surprisingly, there is a reduction in cost of capital. But if the firm do not actually invest in cybersecurity, simply talking about those investments does not generate the same effect when it comes to cost of capital. Now, to further strengthen our identification, we use this DID. So our treatment group are firms that had a cybersecurity investment disclosure between 2000 and 2018. So we see here that the results are largely consistent, that the cost of capital is reduced, and same for cost of equity and cost of debt. Now, interestingly, again, that for firms that made public emphasis about cybersecurity in those SEC reports, but do not actually invest in those cybersecurities, there is no effect. So that is our placebo test here, placebo times post. Now, finally, we have this falsification tests that, first of all, again, for firms that disclosed cybersecurity in SEC reports, but not when those disclosures are not about investments, then it has no effect on cost of capital. So simply just talking about cybersecurity does not reduce the firm's cost of capital. It has to be about investments in cybersecurity. And secondly, cost of goods sold. So we see that disclosing cybersecurity investments would not have an effect on cost of goods sold, which is not entirely surprising because cybersecurity is not part of the production function. It is not producing goods, so we're not having an effect on cost of goods sold. So which again, this speaks to the special characteristics of cybersecurity that is different from other technologies, which are maybe part of the production function. So in terms of implications, first of all, we see that the value of cybersecurity investments would extend beyond its preventive benefits. It is not just about preventing data breaches, that we actually see a tangible business benefit of disclosing those cybersecurity investments. And secondly, now because of those tangible benefits, so CEOs or CIOs, executives may be interested in disclosing those cybersecurity investments despite the fact that there may be proprietary or agency costs. And finally, credit rating agencies, with credit rating agencies really considering cyber risk as more substantial. SEC may want to revisit the fact and looking at cybersecurity disclosing devise certain incentives to properly instigate firms to disclose their investments in cybersecurity. So that's pretty much what I got to say. I look forward to your questions.
Awesome. Thank you all. You all were did a good job at presenting complicated information in a relatively short horizon. Let me see if I can do somewhat similar as I go. Why don't you stop sharing your screen so that we can get all three presenters on the screen at the same time, and then we can have an open discussion if you like. There's a whole bunch of questions in the chat that I will do my best to moderate, but perhaps all of our presenters can have a look down at the questions to make sure we don't miss anything. Jonathan, you want to turn your camera back on if you can, if you have that power. So all of this is really interesting, specifically the finance part, which is presumably what you guys all worry about all the time, is that these cybersecurity risks are not these sort of idiosyncratic risks, but they impact one company, which impacts the economy as a whole, which is what the last two papers are in general getting at. So let me start with Jonathan. There's a couple questions here, which is, let's start with the first one from Rainier, which is, how transferable is SSVC scores across organizations?
Yeah. And so I saw Reiner's question, and also I think Brian built on it, and I think that the questions are related. If you mean the final decisions, Reiner, I think that they're not super transferable, which is the purpose, right? It's stakeholder specific. But if you mean like, is the utility of the vulnerability to the adversary transferable across organizations? I think that the answer should be yes. And I think that the answer is yes for a couple of other things, like the state of the exploitation, which is about what's public. And some of them I think are reusable across vulnerabilities, even though they might be specific to the organization. So I think this is partly Brian's question, where he doesn't want everyone to be having to reevaluate all these questions for every vol. And on the one hand, we've made some effort to make it quick per evaluation by making it a bit simpler. But on the other hand, if you have a properly functioning asset management system, which we're encouraging, something like the exposure or the safety impact of the device that has the vulnerable component shouldn't change across vols, really. So that might not be transferable across organizations. Different organization might use a web server in a way that might be privacy sensitive for one and not privacy sensitive for another. But that's the case where the situation is different, and so the scores should be different. But we're trying to make it easier for the users by having them only have to answer that question once. So there's a setup cost to using SSVC, but it should get easier as you go on.
So I'm going to riff on this for a second and see if I can spin this question to Dennis and Chanjiang. I'm not too sure if I'm pronouncing your name correctly. Correct me if I'm wrong.
You can call me TJ. That's all right.
TJ works. Yeah. Thank you. Why are these risks showing up in beta in the cost of capital? For sort of non-finance geeks out there, we think about some risks as being idiosyncratic as you worry about them because on average they affect, how much expense you have or how much cost you have. But what the last two papers are saying is that this is not something that just shows up as idiosyncratic. It changes your general covariance with the rest of the economy.
Right. I mean, maybe I should start answering that question. First, thanks very much, Rainer specifically, and then also Alan and the others for asking those questions. I'm going to try to answer most of these questions while it's also trying to answer your question, Brian. So first of all, beta itself is a measurement of risk. So in the simplest terms, what we see with an increase in beta, which then results in an increase in cost of capital, is that investors and other market participants think that a company is subject to a greater amount of risk after a security breach. So a security breach basically tells investors or conveys that piece of information to investors that a company is indeed subject to risks, and that risks then would, well, constitute in terms of reduced cash flows, but also in an increased volatility of cash flows. And an increased volatility basically means, well, when we discount those cash flows, that they are lower in present terms. And that is something that investors don't like. And accordingly, this is how the effect of that security breach substantiates. So the inherent logic, so the intuition for the hypothesis is that, well, when as a company suffers from a security breach, investors realize that they are subject to risks, and that results in volatility, and that can be measured in terms of beta. Also, to just address the time frame questions, and also why the sample size for a regular beta, downside beta, and upside beta are the same. It is important to keep in mind that each daily beta factor is actually calculated over a period of 1 year. So that is 250 trading days. And we average 60 trading days before and after a security breach event to basically arrive at one pre and post measurement. That is because daily beta factors are highly volatile. So in any kind of analysis, you would very rarely pick one particular day to establish changes in risks. But as was rightly mentioned, you do that over a particular period of time. So you average daily betas in order to arrive at a reliable measurement.
TJ, do you have anything to chip in on that, or?
So I guess Dennis already explained it very well, but I'll just add that I think in cost of capital estimation, credit rating is also part of it. That if a firm has a higher credit rating, its cost of capital is understood to be lower. And also, as I mentioned in my presentation, that for credit rating agencies like Moody's, they are starting to look at taking cyber risks more seriously as part of their estimation for a firm's ability to potentially pay back debt, for example.
So here's the question that I thought was interesting, which was, this is from Stephen Bonner, which is, so this is specifically to Jonathan, but we can all chip in, which is, how do you consider the impact on users/customers? And I think the thought experiment he has in mind is a security breach that has nothing to do with the profitability, the risk of the company. Beta's not changing, your cost of capital is not changing. Everybody's getting wealthy, but somehow users and customers are impacted.
Yeah, I think this is a really important question. So when we started off the development of SSVC, we had safety impact as a metric, but we actually sort of morphed that into well-being impact. And so I would say that if there's a privacy loss that's going to register on the scale of physical harm, right? Because there's enough people who have had some sort of psychological harm, or they've lost some time, which amounts to losing money at some point to fix the problem, then we're going to try to handle that under well-being impact. We've gotten some feedback from some of the suppliers that they don't know the details of exactly how their software is used. And so we've got some sort of concept of public well-being impact, which is a bit more coarse than like a very situated well-being impact that like a specific deployer would know how their software is used. I don't know whether that sort of well-being impact is routinely included in things like cost of capital, but that might be orthogonal. I'd be happy to hear if that's not the case.
I mean, I think what makes it an interesting thought experiment is it is hard to imagine a situation where profits and risks to a company are completely independent of harms and risks to your customers. But I think that's partly what makes it an interesting sort of question.
I mean, I'm a novice at this, but my understanding is that internalizing those externalities is what the privacy regulations we're seeing coming online are for, right?
Yes, that seems like a good way of setting it. Okay, let me skim down and see if we have. So let me this was, I think, Alan's question that came up in Dennis's question, which was, when thinking about sort of the security breaches, like as an event, is it fair to consider them as an event, or are they sort of more ongoing? So Dennis sort of has this, what in finance called an event study, where something happens and you measure the stock price reaction pre and post to that. Jonathan, would you seem like in a good position to be able to comment on Dennis's methodology here, in the sense of, can we think about this as an announcement as a discrete event, or is it more of a trickle of information?
Oh, I mean, that's a hard question, and I would, I think it makes sense from what I understand of Dennis's point of view, that I'm not a finance person, that the announcement is a discrete event, and that might be the thing that impacts the market. The security incident is a process, but there is going to be a discrete announcement if you make it public, and that seems, if you're taking that as the causal event, that makes some sense to me, within the context that the incident itself will be ongoing. Is that what?
Yeah, it is a hard question. So I'm not too sure I phrased it in a way that made it any easier. But even if I had, it strikes me as a relatively hard question. Dennis, any thoughts on that?
I would certainly agree with what Jonathan just said. So, well, in terms of event studies, by definition, you're looking at the impact of one day or one particular event happening on one day. And yes, indeed. So any sort of after effect or after breach implications can substantiate over the course of time. But that's sort of the beauty of using financial market data. So the very idea of using financial market data is that you sort of accumulate the wisdom of the masses. So everyone who is analyzing and investing in a breached company basically utters their point of view via the movement of share prices and via the movement of, well, by implication, and also beta. So one could argue that share prices provide a nice perspective on those, what we call underlying and consequential costs of security breaches, particularly because they sort of imply all those changes that will only substantiate in the future. So by definition, share prices are a reflection of what investors think will happen in the future. So all share prices are a reflection of future benefits discounted to the present. And by that, all investors, sort of by implication, assess the effect that a security breach will have not only now, but also in the future. And beta is a particularly interesting measure to analyze that relative to just looking at share price reactions around a security breach event or a security investment event for that matter, because beta is by its definition a long-term perspective. So as I just said earlier, every daily beta factor is calculated over the period of one time. So it's a regression-based factor that is calculated over 1 year. And so by definition, then beta looks at a longer period of time than if we were only to include the share prices of, say, 4 or 5 days or even up to 60 days around the particular event.
The TJ, there's a couple sort of questions in the comments that are sort of around credit ratings. Did you want to say more about your impacts on credit ratings, which struck me as an interesting component?
Let me check the question here.
I'm sort of aggregating a bit of the question specifically. So let me ask directly, what is a credit rating and why does it depend on cybersecurity risk, and does it do so thoughtfully? Are credit rating agencies thoughtfully thinking about cybersecurity risk? Maybe that's a direct way to ask the question.
I guess based on the anecdotal evidence of Moody's example, I guess they are, at least they say they are, that they are taking this more seriously than before. But whether they are thinking about it in a more systematic way, that's I guess that's up for debate. But I guess the point here is that the credit rating is directly related to a firm's cost to access capital, access finance. So, that's why we included that anecdotal evidence here. I don't know if I still haven't found the question in the chat box. Sorry.
I am, it might be my impression of the questions in the chat box, or mixed with mine. So here's one. I do not know the context of this question, so let me ask it, and then hopefully you can interpret it. And so this is Ross Anderson's question. I wonder how the growing importance of site ratings will interact with all this. Does that resonate with you, Jonathan, as to what a site rating is?
I think that it was BitSite, and I'm not familiar with actually what.
Oh, sorry, I missed out the specific. Thank you.
And so that's an organization, and I don't know actually the answer to that question, but I'm going to try to. I will try to find one.
Yeah,
but I don't.
I mean, here's the obvious follow-up for Dennis, which is to change the event as being your change in ratings on BitSite, redo all your analysis on what happens to stock reactions when they change that. That's what struck me. That strikes me as something that is an interesting follow-up.
Well, in terms of ratings, and also let me refer back to what Tianjian just said. It's interesting because in my follow-up study to the one that I've just presented, I'm actually looking at cost of debt and looking at cost of equity and debt in combination. So looking at the cost of capital after security breaches is sort of the opposite to what we've just been looking at in terms of investments. And so the evidence that, well, the literature seems to hint at, but does not yet seem to exist explicitly, is that credit ratings are indeed affected simply because rating agencies deem that after a security breach, at least, that the default risk increases. What is essentially what rating agencies try to get at. So default risks increase, and hence that talks to the cost of debt perspective that was also mentioned in Tianjian's paper.
Yeah, I'll add that I think there's a recent study on JFE talking about data breach effect on sales, among other things. So so data breach does impact the firm's fundamentals in that sense.
We have a couple minutes left. I don't feel like I have done an expert opinion or expert job of moderating the chat. Have you guys seen any questions in there you wish to address? I want to make sure I haven't stepped on any toes. Jonathan, any last comments?
Yeah, there is one from Jan, it looks like. Just a comment about asset management, which so you don't need to use an asset management system for our SSVC, right? You can hand assess exposure for every vulnerability, and that works totally fine if you don't have an asset management system working yet. The other thing is that it's interesting, the sort of sector split of who has functioning asset management systems, which might be an interesting. I wonder if these sector-specific norms correlate to the other things that Dennis and Tianjian have found, like the industrial control system, folks who own and run factories definitely have functioning asset management systems for their devices and where they are and whether they can like maim a person or not. The software bill of materials, SBOM stuff, if anyone's interested in how to do something like what those ICS folks are doing for regular software companies, I'd suggest you look at the SBOM work, software bill of materials. And I also like the other end of the tech industry, like Google and Amazon and Microsoft definitely have functioning asset management systems because they know like which hard drive is going to fail tomorrow. And so there's this weird gap in the middle of people that don't have them. And I think all we're trying to do is show people that if they have them, they can use them functionally and to make it worth their while to sort of get one going and give them a ramp. But I don't know. And I guess that is a question for you both about if there's sector specific correlations.
It is a good question, Dennis. Did you find sectors which were more systematic to be bigger effects?
It is actually a very good question, Jonathan. Thanks for that. In the paper, we do actually attempt to run cross-section analyses and try to look at the impact of different sectors. And we do not find a very strong effect, neither in terms of different geographical areas, which would imply different sets of regulations that companies are subject to, nor in terms of industries. What we do find is we distinguish between US listed and non-US listed companies. And it seems that companies listed in the US are more subject to changes in beta following security breaches, but there's very much in line with the literature, and just intuition, which will tell us that well, the market in the US is just way better capitalized, and theoretically information flows faster to investors, well, that leads to information just being priced into any stock prices quicker. I don't know how we're doing on time, whether I should address two questions that were asked, one by Daniel Schatz and one by Art Mannion about the sampling. So just very quickly clarifying the confounding events. So confounding events that we excluded were those, for instance, if a company was bought or so acquired after a security breach, if the ownership basically changed, or if there were drastic other news items in that particular event window that we used, which is not 5 days. So it's not a 5-day breach report window. It's those 60 days prior to and after a security breach. And then just quickly to address the question of specific/intentional targeting, only those security breaches, or those what we call severe security breaches, were included that were very clearly possible to attribute to an underlying company. We basically tried to build a sample from the perspective of an investor. So for every breach event or every description that we read on the internet, so we qualitatively assessed every entry on the PRC database. And based on that, we always ask the question, would the average investor be able to identify from that one news item which company was actually breached, or which underlying listed company could be subject to changes in the risk assessment of investors? So if it was clear, for instance, from a Wall Street Journal, a New York Times article, or a Bloomberg or Reuters item, then we included it. Otherwise, if it was not clear who was the specific or intended target, we excluded that data breach.
Awesome. I think we are bumping up against time. TJ, I see your co-author is back with more of can finance markets predict cybersecurity events, right? So the next session after our break has an insider trading paper. So those of you that haven't bumped into finance are getting a good dose of finance today. That seems like a good thing. Any last thoughts? I think I'm not too sure exactly how we can give our presenters a round of applause, but I can do so on behalf of everybody. Thank you all for, there we go. We have the, your clap hands are available on Zoom. So hit that clap button. So thank you all. You guys were, that was really an interesting session. So I will turn it back over to Richard, I think, who's running the breakout rooms. Thank you all.
Thank you all.
Thank you.